So in this video, I'm going to share 6 investing mistakes that people are making that can end up costing you thousands of dollars. And sadly, these are mistakes that many people can end up falling into. I've made many of these mistakes in the past, and it's important to understand how these work and how you can prevent these so that you can save a lot of money in the process. So let's not beat around the bush. Let's just get right into this video. But if you are new here to the channel and you want to learn more about personal finance, saving money, making money, and building a better financial future for yourself, then make sure you hit the subscribe button and drop a like on this video if you find any value in it. So let's get started here. Let's talk about one of the first mistakes that so many people make. And this is a very, very common. This is something that I was susceptible to when I first started investing. And it was essentially not understanding the difference between gambling versus actual investing. And see, I think a lot of people when they start, and maybe this isn't you, but I know for myself when I started investing, I was really sort of speculating rather than making logical investments based off of statistics and based off of numbers, but rather looking at my emotions, thinking about how much money I could make, and thinking about the hype of a certain product or a stock or a company that you might be investing into. So that's one of the first tips there, to make sure that you understand the difference between speculation and investing. And see, the whole purpose of investing is to minimize as much risk as possible while at the same time maximizing as much return as possible. That's the whole point of that. So we want to be very careful with that. And there's a lot of different books that we could recommend for investing. One of the best ones of all time that I would say is one of the best is called The Intelligent Investor. And actually, the first chapter in this book, we won't go too into detail on it. You can pick it up. I'll leave a link for it down in the description if you're interested in it. But it's one of the best-selling investment books of all time. So if you're looking to get started investing, you want to learn a lot more about it, check out that book. The first chapter, I believe, is called Speculation versus Investing, and the difference between those, and to make sure that you're falling into the right category rather than speculating. So that's the first one there. Let's talk about the next one, which is paying too many fees, paying too much in fees for investments. See, back in the day, you used to have to call up your stockbroker and say, hey, I want to sell, I want to buy, or go into your financial institution to buy and sell stocks or investments or mutual funds. Then it kind of changed to sort of, you saw E-Trade or TD Ameritrade, where you may be paying $10 for every time you're buying or selling stocks. But now we've entered sort of this new phase where essentially investing should be free in terms of fees. So one of my favorite brokers to use is M1 Finance. This is not really a sponsored video. I do have an affiliate commission down in the link below, down in the video description below. So if you are interested in investing for free, then I would suggest checking out M1 Finance. They're a wonderful company. I really don't promote very many companies on this channel because the truth is I don't like all of the brokerage companies, but I have to say M1 Finance is one of my favorites. They're very reputable, and it's a company that you can use to invest into the stock market for free. So if you're paying too much in fees, look at how much you're paying, not only with buying and selling stocks or ETFs or mutual funds, but also look at these rates that you're paying for these mutual funds or ETFs. So there's something called an expense ratio on these different funds. So you might see something where it essentially costs you 1% or 0.5% for someone to manage this fund for you. We're talking specifically about mutual funds and ETFs and index funds of some sort, might have some type of expense ratio or fee that they might have on there, a management fee. I would try to not pay too much in fees. I really don't like to have expense ratios or those management fees anywhere above 0.25%, 0.5%. Obviously, there's some funds that do take a lot more effort, a lot more work going into them, actively managed, so they could require higher fees. But generally speaking, I really try to avoid as many fees as possible when it comes to investing. So check out M1 Finance. If you're not interested in them, you could also use Robinhood. They also offer free trading as well. And if you do not mind paying $10 for a transaction fee, then you could look at some of these other ones. But times are certainly changing, and I would definitely consider getting one of these apps that makes it so much easier to buy and sell stocks. So let's talk about the next one here, which is investing money that you cannot afford to lose. This is incredibly important. And look, I have to say, I'm not a financial advisor here. This is just free information. So you need to make sure that you're doing your own research. But investing money that you can't afford to lose, this is a very terrible mistake that so many people make. And what we're talking about here is either you're borrowing money to invest in the stock market because you think you can make a lot of money, which maybe you can, but in some cases you might not. And if you're borrowing money, buying on margin we call it, or borrowing money from someone else so that you can invest, terrible, terrible decision in most cases. So you should not be investing the money that you need for next month's rent, that you absolutely need to pay your bills. You shouldn't be investing that money, all of it, into the stock market, thinking that you can double that money and then pay off your rent in the future or pay off your credit card bills with the money that you're investing. If you have a lot of debt, if you're swamped in high interest debt like credit card debt or personal loans, anything in the double digits in terms of interest rates, then you might want to consider paying that off first, or at least getting a hold on that before you start investing into the markets. I think that's one of the worst positions that people can get in. Once they start to find themselves in debt and they say, what's a great way to get out of this? Maybe I can invest into penny stocks or invest into these hot stocks that I heard about, in an elevator somewhere that somebody told me about that's going to blow up tomorrow, going to grow 400% tomorrow. I can take this money from the stock market that I make and then pay off my credit card bills, pay off my debt. That is not a good plan. It's almost always going to be putting you in not only a very stressful position, but something that can end up really hurting you in the long run. So make sure you are limiting risk to maximize your reward by not investing too much money that you cannot afford to lose. Now, if you've already got your expenses covered, if you're able to pay for your rent, you're able to pay for your electricity bill and your car payment and maybe some of your credit card payments, and you want to start investing into the stock market, then that can be a great option. And that's actually kind of leading us into the next point here, which is a mistake that people make, which is that they end up waiting far too long to start investing into the markets. And so I'm going to kind of spin you around here, because we just said that you want to be careful that you're not investing money that you cannot afford to lose. But I also want to mention that, look, I think it's important for everyone, if you are interested in growing wealth over your lifetime, to consider getting your feet wet in the markets, even if you do find yourself in a position where you don't have a lot of money at the moment. Even if you do have some debt, I think it's a great idea to get your feet wet. And when we're talking about this, we're talking $5 a week, $10 a week invested into the markets, so that you can sort of get a better understanding. Because one of the best ways to learn about investing, whether you're investing into bonds or CDs or the stock market or real estate, one of the best ways to do this, besides reading books and learning free information like this YouTube video, is to actually have the experience, to actually try things, possibly fail, possibly win, but end up over the long term gaining a lot of wisdom when it comes to the markets. The longer you are investing, the more you learn, the more mistakes you make, but then the more you learn from those mistakes and you don't make them again, and it makes you a much better investor from what we found. So that's something that you do want to consider, just getting started very small, and we're going to lead into the next one here, the next point, which is a mistake people make is by trusting experts too much. Okay, so we're talking about stock market gurus, people on forums, even people who have YouTube channels who are telling you to buy this stock or sell this stock. I think that's something you want to be very careful of. And we can even go on top of this and say, even very notable investors, even say Warren Buffett. If you see in the news that Warren Buffett is buying American Airlines, or he's buying Southwest Airlines stock, or he's selling Apple stock, you shouldn't necessarily be buying or selling something just because a very good investor at the top is doing that as well, because in some cases they can be wrong and they might have a winning track record, but you really want to think for yourself and try not to follow the crowd too much, but rather make sure that you are able to understand the logic behind it rather than just following other people. But be very careful of these investors or these experts that you might see who are trying to sell you some type of program or some type of thing where they're trying to get you to buy into penny stocks so they can pump them up and then dump them. Pumping and dumping, it's a big scheme. Used to be around a lot more during the dot-com bubble, but it's still very prevalent. People are pumping and dumping all the time. You want to be very careful of it. So the last mistake that I'm going to share with you in this video is by trying to time the market. Now, I think there is certainly something that is nice to be able to sort of look at the economic cycle and say, if we've been going up for 10 years, that we're probably going to see some type of economic downturn or a recession in the next year or two or three. But I think the problem really comes in when people try to time the market too much to the point where they end up missing out because they end up never investing. They say, well, it's 2012. We had a recession a few years ago, but I'm worried that we're going to enter another recession, so I'm going to wait. I'm going to wait until the market goes down further, and then I'll start investing. And then 2013 happens, they say the same thing, 2014, 2015, 2016. we're all the way up in 2019, almost 2020, and people are still holding off, waiting to invest into the market for the perfect time, which is very difficult to actually predict. So for myself, and like I said, guys, I'm not a financial advisor, but for myself personally, what I like to do is I like to do some dollar cost averaging, where essentially I'm smoothing it out so that I'm investing in times where we're in good economic times, but also poor economic times, so that really smooths out the curve so that I'm really growing my assets over the long run. Now, you also want to understand that regardless of where the economy is at the moment, there are going to be companies that are performing very well and companies that are not doing very well. This happens even during the worst economic times. You look at 2008, 2009, a lot of companies in the United States were performing very poorly. We were going into this economic contraction, but there were still companies that were doing very well. Look at Dollar Tree, look at Walmart. There were companies that were doing very well, bringing in record-breaking numbers of revenue during very hard economic times. And then at the same time, you can look at companies now in 2018, 2019, 2020 that are performing very poorly during a very good economy. So try to find companies that are valuable, that are within this mix, and it's getting more difficult to do that as the markets are rising, but they still do exist. You can find an undervalued company in any market, in a high market, in a low market, you can find undervalued companies, and that is really the key to finding success. So if you found any value in this video, make sure you drop a like, share this with someone who you might think might find some value in it, and thanks for watching the video. I appreciate all the support on the channel, I really do, and I'll see everybody in the next video.